term, and this is shorting. And I know you've had a few questions about what shorting is. I know I've kind of explained it a little bit to you, like here and there. But what is your overall idea of what a short is? How do you make money off of a short? What is a short?
Um, I really don't know.
Okay.
I thought it was like making money off of people selling or something to share. I don't know. I really don't know.
Okay, you're
That's why
good.
I wanted to get
Most
into it. But
most people don't know what a short is, and I didn't really understand. No one ever really explained to me what a short was, and I had to like watch a ton of YouTube videos to figure this out. So this is the best example that I've come up with that made the most sense for me. So a short is basically a way that you make money off of a company going down or losing money.
Okay.
So let's say Tesla is trading at $300 a share and you believe that they're not going to make the Model 3 in time. Or let's say you think that Tesla is overvalued. People believe in Elon Musk too much, and you really think that electric cars aren't the way of the future. You think that gas is the way to go. You believe in oil. You believe in all that stuff. You don't believe in Tesla. So what you can do is you can borrow shares from someone else, and then what you do is you make money by those shares going down. So the way that I kind of explained a short working, and I just said you make money. So the way you make money on a short is by making money when a company is bad or doesn't perform well. So what you do in this example that we have over here, you have guy number one owns 10 shares of company A at $10 a share. So he has $100 worth of this company A, right? And these shares are worth $10 a share. What happens is guy B comes to guy A and says, hey, I want to borrow your shares from you. He says, I want your shares and I'll give you maybe 5% interest on you loaning me your shares for a year. Let's say he offers a 5% APR on borrowing this guy's shares, right? It varies per company, but let's just call it 5% for easy math, right? So what guy B is going to do is he's going to say, hey, guy A, will you give me your 10 shares? I'll give you, he said, I'll write up a contract and I'll give you these shares back at the price of $10 a share, plus I'll give you 5% on that. So I'll give you $105 worth of company A when all this is done, right? It's guaranteed money. So guy number one is going to get his shares back plus 5% on his investment. And guy A or guy number one, guy A is going to go, yeah, that's easy money, because he's like, I believe in Tesla. I think Tesla's going to the moon. I think this company is going to do great. So I don't know what this guy's thinking. Sure, I'll give you my shares. I'll make money on this. Plus, I'll make money as it continues to go up. And so what he does is he gives his shares to guy B. Now, the way guy B is planning on making money is he will take those shares, and the market is trading at $10 a share, right? What he does is once he has those shares, he instantly sells those shares. So he sells them back on the market, and now he has $100, right? He got the money from those shares.
Mm-hmm.
Now, what he's expecting this company to do is to go down. He expects to see company A, or we're calling it Tesla at this point, right? He expects to see Tesla go down in value, right? Because he's going to make the difference in what the shares drop to. So what would happen in this example is, let's say it starts out at $10 a share and it drops to $9. Well, now he's made 10% on his investment right there, right? Because they're at $10 a share. Now they're at $9. The shares dropped 10%, right? Minus his interest, which is 5%. So he would be at 10. Does that make sense?
Okay. So he sold them off.
Yep, sold them off.
This high.
Yeah, he sold them off at $10 a share.
$10
right
a
here.
share. Okay.
Yeah.
And now, so
And
he
then
doesn't have any shares.
He doesn't own any of the shares. He
Okay.
needs to buy them back at a lower price in order to make money, right?
Exactly.
So he needs to make money by the share going down. So he's going to hold off. He's going to wait. He's not going to own any shares. He just has an obligation to pay guy A back eventually at that $10.
So he's never going to make more than what he originally bought them from then.
No, he does, because this is how he does it.
Okay.
So how he does it, right? So as time goes on, if he sold at $9 right here, he could buy back those shares, 10 shares at $9, right? And what's 10 times 9?
10 times 9, $90.
$90, right? and he owed the guy 5% of $100,
Which
right?
is 105.
Which is $5, right?
Which is yeah. So he
$5.
owes the guy 105
He would,
dollars.
yep, he'd owe the guy $105. If he bought 10 shares back at $9 a share, he would be only spending $90, right?
Mm-hmm.
So he would have profited $10 by buying them back at a cheaper price.
Yeah.
And then he would still owe him another $5 for interest. So he would have made $5 basically on that short in this scenario. Does that make sense?
Okay, yeah.
We'll keep going. I'll give you another
Yeah,
example on
another
here.
example.
So let's say the company went down and he didn't buy those shares back at that price. Well, now it's back up at $10, and he's like, "Oh crud! I'd actually lose $5 because if I bought them back at the same price, I promised to pay him back 5%. I'd lose money at this price." So he's like, "I can't buy them back here." Well, then it drops to 9, and he's like, "I think it could go lower. I think it could still go lower than 9. I'm not going to buy back in there." Well, he waits, and it starts to get more expensive. So this is where Guy B gets in trouble, is because the company is worth more money now, and he's losing even more. So this is why shorting is really risky, because this company could go to zero, right? And the guy he would basically double his investment, right? Basically.
Yeah.
Well, if the company goes up, it could go up to $11, $12, $13.
So when it goes up, wouldn't Guy want his shares back to sell them, or I mean to?
Well, he believes that it could go higher, so he doesn't care.
He doesn't care.
He doesn't. I mean, he's not looking to sell them at any price point right there. He's like, hey, just give them back to me. I think this company could keep going up.
In the contract, does he say at a certain time?
They sometimes do. Sometimes there's a time limit on how long you keep them. Sometimes there's not. But see, this is the problem: is with short selling. If this company is up here at like $13 now,
you've lost so much money.
You would have to buy those shares back at 13. You would spend $130 plus the $5 in interest. You would owe him 30. You would lose $35, or 35% of your investment would just be gone because you had to buy more expensively. And this is the problem with shorting: is if this company, let's say this company went to $100 a share, he would be losing massive amounts of money, right? Guy B would. Guy 1 would still be happy because he still gets his 5%, plus he gets his shares back at 10%, or at $10, and so he's good. But this is where Guy B starts to make money, is once it starts coming back down, it drops down here to $7, and then it's $7.50, and then it drops down, and we're down here now at, let's say it's at $5 a share. So this company,
$50.
And this is where, if you're a short seller, this is where you make your money now. It's at $5, and let's say he goes, you know what? That's what I wanted to make on it. He goes, that's about as low as I think it's going to go. I'm going to buy those shares back. And so what he does now is he's going to buy these shares back
at $50 total.
At $5, $50 for those shares.
The other guy $5, so he's making $45.
Exactly. So he just made a 45% profit now off of that. Because the company did bad. Exactly. And so then he bought those shares back at a cheaper price. He keeps the profit, pays his interest. Bada bing, bada boom. So shorting can be very lucrative. You can make a whole lot of money doing shorts. Because sometimes people go, oh, I know a company's going to do bad, right? I know this company's like Blockbuster, right? A few years ago, if you would have seen Netflix or Redbox coming out, you'd have been like, easy money, right? Like, that's not going to be worth anything, and you could make it, make bank. The thing is, though, is if the company starts to do well, you could lose infinite amounts of money if you don't cover your position. And so that's kind of the cool thing, though, with shorting, is you can make a lot of money. Like, I have a friend, Rhett. He's the one that went from $30,000 to $900,000 in a year.
$900,000
in 10 months. Yeah, he did a lot of that shorting. He would short massive amount, he'd do massive shorts, and he would just make money on the downside. So shorting can be really great, but you're not going to be able to do shorting on Robinhood. It's hard because sometimes you can't acquire the shares. There's no one that's willing to give you the shares of their company to trade. Sometimes it's really expensive to borrow those. The interest rates are super high, and so that's hard to do as well. There's just a lot of things that go into shorting that the new investor just doesn't know what to do. Yeah. There's things called options trading, which you can buy calls, which is you think the company's going to do better. We won't go into options trading right now, but there are ways to do what's called a put option and buy basically bet that the company is going to go down. I just don't like those ideas for new investors. I think it's good to stick with this, and as time goes on, start branching out. But um, that's kind of shorting. I mean, it's not a bad thing to get into if you understand certain things. But I don't like doing long-term shorts. If I'm shorting a company, I'm like, it's a day trade short. It's usually what I the way I do it is I go, okay, this company just went up 8% today, right? 8% is a large jump in one day. And I'm like, it's going to pull back a little bit. It means that people overbought that company and it's going to sell off a little bit the next day. And so I'll sometimes do that.
Have you done shorting before?
Yeah, I've shorted. I think I made like $1,300 shorting Tesla last week, but it took like a $56,000 position. So it's one of those things like you can make a lot of money. Like I said, shorting, and it's good. I just don't recommend getting into it because you do need to use TD Ameritrade or another E-Trade or a different one besides Robinhood in order to do it. Um, and most people, like I said, just don't. There's so many other steps in it because you have to understand interest rates of what you're getting it loaned to you for. You have to understand if it's APR on the interest, if it's daily compounding. If you short a company intraday, there isn't interest on it, I don't believe. But if you hold it overnight, then that's when the interest starts to accrue. Um, it's just it's a little bit more technical.
So a lot of compared to the other ways of trading, that's the most advanced then, would you say?
Yeah, I mean day trading, whether it be I guess it
Day
would
trading
be day trading
shorting,
is risky, but yeah, I'd say shorting is probably the one of the more advanced methods, and then options trading is going to be just as advanced as shorting. So
shorting, you have to be kind of like day trading. You have to be on top of it, like paying attention to it all the time.
yeah, because if that company rips up and shoots up, right, you might want to you might want to buy your shares back right there, because what if it keeps going up? You do want to be a little bit more on top of it. Some people will do long-term shorts. Like people have a long-term short position. A lot of people have long-term shorts in Tesla right now because they don't believe that, they believe that Tesla's overvalued, et cetera, et cetera. But for the normal person, I'd say you don't want to be in a short too terribly long. I don't know, because I don't want to pay interest on it long term. That's my thing with it, is because not only do I now have to make sure that it's going down in value, and the market as a whole right now is going up. So you're almost betting against the market right now. You have to really find crappy companies in order to make money in it, because overall the S&P 500, the Dow Jones Industrial Average, the Nasdaq, those are all going up overall. Most companies are doing better right now, and so you're having to find those companies that aren't making money, and then also pay interest on that money those shares that you're borrowing. So it's just more risky right now. In a recession or in a downturn in the economy, yeah, shorts are great, right? Because everything's going down. So yeah, that's everything. So any more questions?
Good.
Man, I think we covered a whole bunch of stuff in this video. I think we're going to have to edit this down a whole bunch. But thanks so much for tuning into Young Money Investments. Let's thank Jonathan for getting to be here and for giving us some new trader insights and some of those questions that I'm sure a lot of you all probably have as you're starting to get involved in the market. So thanks so much for tuning in. Talk to y'all later. Bye.